Should you invest in a short-term rental or Airbnb in a place like Hawaii or a place like Ohio? Today, we're going to answer this question once and for all. So for today's video, I picked two properties that are each located on opposite ends of the spectrum in just about every category that you can imagine. And most people would assume that Hawaii is the clear winner when it comes to vacation rental investing or ownership, and that there's absolutely no way that an Airbnb in the Rust Belt could ever compare to one in the tropical Aloha state. So I had to do a bit of work to find similar properties in both locations so that we could really compare apples to apples today. Both properties are currently listed on the market. Both provide multiple streams of short-term rental income in the same property, and both should bring in almost the exact same amount of income on a monthly basis. However, one of these properties far outperforms the other in my personal opinion. So how is this possible? Like, if they both generate the same amount of income, how can one outperform the other by so much? So let's jump right into it so you can see why short-term rental investing isn't always what it seems, and that the real story is often a little bit underneath the surface. So first, let's head on over to the beautiful tropical state of Hawaii. And Hawaii holds a special place in my heart because I lived there for 2 years and it was absolutely gorgeous. I loved every second. You can see why people would want to own property there. And the property that we're going to talk about today is located on the Big Island of Hawaii. So this is sort of the main island, the Oahu, where Honolulu, the capital of Hawaii, is located. That's where most people fly into. That's where Waikiki is. But the property we're going to talk about is on the Big Island, which actually ironically holds 8 of the 13 climate zones on the Big Island. So as you're driving around the Big Island, you can feel like you're in a rainforest 1 minute, on the moon 1 minute, in a desert another minute, and then you're at the beach another minute. It's wild. So you can see where this property is located. It's not, right on the beach, but it's not too far away either. It's in a nice neighborhood. This is the street view. This is before it was rehabbed, so it looks a little bit different in the pictures now, but it's right across the street from some really beautiful multi-million-dollar properties in a nice neighborhood. So I get potential short-term rental deals sent to me on a daily basis from Rabu. Rabu's a data analytics site for short-term rentals. They also sell short-term rentals or recommend short-term rentals that could work well. And so this property was sent to me a while back, and it's very similar to the other one that we're going to analyze today. It's got 2 units in it. So one of them is a 3-bedroom, 1-bath. The other one's a studio apartment. Here's the pictures. You can see it has been rehabbed. This is the front of the house now after it's been rehabbed. You can kind of see the ocean in the distance there, and it's nicely updated. It's nothing like over the top in terms of updates, but it's pretty nice. Then this is the studio entrance down below. So smaller studio apartment down below. So we're going to assume that you can, rent out both, and we'll run the numbers as 2 units worth of short-term rental income. The next step that I always recommend is to go to AirDNA and plug in the location, plug in the town. So when we put in Waikoloa, hopefully I'm saying that right, you can see that there's a 67% average occupancy rate in this area. You can see where all of the properties are. There's a whole bunch of them right near the subject property here in Waikoloa Village, and there's a $598 average daily rate. Sometimes that can get skewed a little bit because in higher end locations, there's some really high end places that kind of bring up that average daily rate. Our property isn't necessarily a super high end property. There's 1,857 active short-term rentals in that area. And then you can go down and you can see how the occupancy rate looks in different seasons. So it really dips after the summertime, kind of kids go back to school, and then it starts to pick up as you get into the winter months when people want to get out of the cold winter months and get to a warm location. But it's a pretty steady market overall. It's not like super seasonal. So then from there, I go to Airbnb and I plug in the actual address of the subject property in Airbnb, and then Airbnb shows me all of the recommended properties around that address. So you can see this is the address. So you put a dot on the map, and then you can zoom in and see all of the comparable short-term rentals around it. And as you click on them, you can start to see just an overview of the listing. And then they're also over here. And as you scroll over it, it'll highlight where it's located on the map. So what I did is I pulled up comparable properties. I started with the studio apartment and tried to pull up as many comparable properties right in that area to see what are they asking on a nightly basis. So this one, for example, it's another 1-bedroom, 1-bath, very similar size, guest suite in a property, so almost exactly what we have. When I looked at the pictures, very similar in terms of the condition, that sort of thing. They're asking $127 a night. Now, Airbnb just recently changed it to where you can't see all of the fees broken out separately. So now they'll just show you the overall cost and then they'll show you per night. But this includes the cleaning fee and Airbnb's fees in it as well. Used to be able to see all the fees broken out separately. So now you have to subtract out the cleaning fee and Airbnb's fees from the nightly rate. So you have to assume on a nightly basis, if you're going to subtract those out, it's probably about $100 per night for this property. And that's kind of in the off season. June's not like a peak season, it's sort of like a mid season. And then you can look in the slowest season as you get toward the end of August. Actually, we'll pull up September because that's the slowest season. They're at $180 right now. So a little bit more expensive actually, but it's further out. But then you can see in December at $180 as well. So probably don't understand pricing that great. This host isn't like a master of pricing because that doesn't make as much sense, but you can kind of see where they're at, where some of the competition is at. Looking at the next studio. So here's another guest house. So this is a 1-bedroom, 1-bath, similar to ours, and they're similar price point. So this is in November. We can go back to in October. You can see they're at $180. They kind of keep their pricing right around $180 as well, but then you subtract out the cleaning fees, the Airbnb fees, and they're probably like $130, $140-ish. And then you can look at the next one and just do this for as many comparable properties as possible. And this can give you a really great idea of what you can expect then if you have a short-term rental in that area as well. So this is a 1-bedroom, 1-bath as well. This one's really a nice place, a little bit higher end than the others that we're looking at, all 5-star reviews. And so they're at $302 for 2 nights. So you subtract out the cleaning fee and Airbnb fee, and this one's probably like $250, but it's a little bit higher end than what we have. So you can go through that, and then we did the same thing for the house as well. Here's an entire home. So a 3-bedroom, 2-bath home. Similar, it's got 1 extra bedroom, but very similar to the upstairs house. And you can see what the price points are here. And this one's $360 or $396. Again, minus the cleaning fee and Airbnb fees. Did the same thing for this house. Same thing for this house here. So after you do that, you get a really good idea of nightly rate and occupancy. So then you can go back over to your analyzer tool then and start plugging in the numbers. And so if we plug in $799 is a purchase price on this property, $25,000 closing costs after repair value, we estimate about the same, about $800,000 because it's already all updated. The property taxes right now are $64.55. We're going to estimate about $4,000 for insurance. $20,000 about in repair costs. That's like, there's always some updates, some surface level updates. It doesn't look like it's fully rehabbed. And then furnishing costs about $45,000. You can get a DSCR loan, which is an investment loan, for 80% of the purchase price. Pretty much any bank will give you a 80% loan to value DSCR loan as long as the property cash flows, which this does. So that means the loan amount is going to be $639. So you're going to have to come up with $160,000 of down payment plus the furnishing cost, plus the repair cost, plus the closing cost. So it's right around, I believe, about $250,000 is what you're going to need in cash to purchase this property. So then from there, you can go to the income and expenses, and you can see, okay, in the high season, based on the comparable properties, we're going to say the studio rents for $165, and the house itself, the 3-bedroom, 1-bath house, rents for $380. Then in the low season, the studio drops down to about $145, and then the house drops down to $250. And we kind of came up with these numbers based on what Rabu provided us too. So we're going to give this owner the benefit of the doubt a little bit. We're going to give Rabu, I guess, the benefit of the doubt because they said that they are projecting about $131,000 of income based on the numbers in this area. Typically, Rabu, they're trying to sell properties. So they're going to err a little bit on the high side, typically, but we're going to give them the benefit of the doubt here. So all of that means that if we have these nightly rates and then we plug in these occupancies, which again, it's less seasonal here than you'll see in the Midwest. So 75% occupancy in the high season, 55% in the low season. So 64% occupancy, we're assuming, which creates $110,000 of income. Then you add in your cleaning fees and you're at about $127,000 worth of income. So this is where I think realistically we could expect in terms of gross income. And then when you look at your expenses then, it automatically calculates your mortgage payment based on the DSCR loan that we put in on the previous page, your monthly insurance payment, your monthly taxes, your monthly cleaning fees. The utilities, we plugged in just a round number of an estimate for utilities. Lawn, obviously no snow removal there, but you can have lawn maintenance, consumables, like paper towels and that sort of thing. And then maintenance. We're going to assume we're self-managing, which I highly recommend. If you have set aside a $300 for maintenance, you're not always going to use that, but you will have CapEx improvements, capital expenditures that come up from time to time and some maintenance items here and there. So if this is the case for this Hawaii property, here's how the numbers look. So we're bringing in $127,000 total, and then we're going to have about $102,000 total worth of expenses. So we're going to be left over with 25 or close to 26 grand of income on an annual basis, which breaks down to $2,100 of net cash flow on a monthly basis. That's actually not too bad. There's not a whole lot of properties in Hawaii that cash flow, but because this one is a 2-unit, you're actually making some cash flow, which is hard to do in a high-end tropical location like this. If that's the case, $2,100 of income means a 10% cash-on-cash return. And that means that for every dollar you put into it of your cash out of pocket between the down payment, the repair costs, the furnishing costs, you're going to make a 10% return from the cash flow on that investment. So from there, let's zoom over to the far less tropical location of Canton, Ohio. This is where our second property that we're going to analyze is. Very similar type of property, multi-unit, short-term rental, located in the Midwest. And Canton, for those of you that aren't familiar with it, is just south of Akron, which is just south of Cleveland. And this property is kind of located between Canton and Akron. So as we zoom in, you can see it's on the north side of Canton. And Canton's most famous, most likely, for the Pro Football Hall of Fame. And so this is not too far from the Pro Football Hall of Fame, which is one of the reasons why people will stay here, amongst some others. So when we look at the street view on this one, it looks like a pretty typical Midwestern town. Nice, decent neighborhood. And this property actually took the Google Street View while they were rehabbing it. Again, very similarly, just recently rehabbed, all updated. So another turnkey property. So here's the listing for this one. So they're asking $349 for this property. It's a 5-bedroom, 3-bath, 2,600 square foot property, and it's actually 3 units. So it's listed as a duplex, but they actually have 3 full kitchens, 3 bathrooms, 3 living rooms. It's one of the units is smaller, and they were kind of combining it with another unit, but you can section that off, or you can close the door basically, and you have 3 full units, which gives this one quite a bit of value because then you have 3 units worth of short-term rental income. Similarly, we go then to the submarket data in AirDNA. So you can plug in Canton also in AirDNA, and you can see occupancy rate is 50% here and an average daily rate of 184. So much lower income per unit in this location. There's 125 active listings, and you can see the actual peak season and the slow season are kind of opposite almost of what we looked at in Hawaii, which kind of makes sense because it's in the Midwest with almost opposite seasons, I guess. So then we go to the Airbnb app itself. You can plug in the address, you can see where it pops up, and you can see all the other comparables around it. And I always tell people, like, if there's no comparables around it, then it's probably a sign that it's not a great place to invest. Like, you don't want to be the trailblazer or the first short-term rental in an area unless you just know something nobody else knows. But if there's a whole bunch of short-term rentals around it, and you can see that bookings are occurring, you can see what nightly rate they're getting, you can see the data that's current data, then you can know what you can expect if you're going to offer a very similar type of property. And that's what's happening here. You can see this 4.94 star rating. There's 97 reviews, 286 reviews. This one has 85, 230 reviews. Like, there's people who are consistently staying, guests consistently staying in this area. And then when you click on each one, you can analyze it and really go through, like, one that's a really small unit. So here's a similar type of small efficiency unit rental, and it has 197 reviews, 4.96 star rating, and you can start clicking on their nightly rates. And ironically, they're asking $170 for 3 nights. That was very similar to what they were charging for the Hawaii property for the efficiency apartment. And you can look in the different seasons. That's in July, so that's a peak season. Then you can look in the off season, or when things start to drop off, and you can see 187 right now. And so you can start to get an idea of nightly rate. You can look at the reviews to see when people stayed 5 days ago, 2 weeks ago, April, March, February. So you can see, are there any big gaps in the calendar? And is that a trend across all the different listings? And you can do that across all of them. So here's at 3-2. You can see what different size units bring in. And so after we do that for the Canton property, then we go back similarly to the analyzer tool, and we can see, okay, if we're buying this one, and this is a property that actually one of the members of my first vacation rental investment blueprint program, my coaching program, has under contract right now. So he's going to close on this very soon, and this property is going to be extremely profitable. So he's buying this property for $345. Closing costs, we're estimating about $8,000. Similar after repair value because it is a turnkey property. It's already rehabbed. The taxes on this are quite a bit lower than the Hawaii property. It's $1,503. Annual insurance is going to be lower. Repair costs are lower. This one's a little bit more turnkey than the last. Furnishing costs about $40,000. Things are a little bit cheaper in Ohio than Hawaii. And then similar loan to value percentage, the DSCR loan is going to have very similar terms. 80% loan to value. We're assuming the same interest rate. And so on this one, the loan amount will be $276 and his down payment's $69,000. So quite a bit lower down payment. And then when we go to income and expenses, we plug those in for the high season and low season similarly, but there's 3 units on this one. And so with the 60% average occupancy between the high season and low season, we're looking at about $102,000 of income. And then once you add in your cleaning fees, we're at $125 gross income. So you can see if we go back to the Hawaii property, this one has $127,000. So like I said, very similar in terms of gross income that's coming in. But when we look at the expense side of the equation, that's when things start to change. So because this one is less than half the cost of the Hawaii property, our mortgage is going to be a lot less. Our insurance on a monthly basis is a lot less. The property taxes are a lot less. Cleaning is about the same, probably, somewhere in that neighborhood. We're going to leave the rest of these about the same. Consumables will be a little bit higher here because there's one more unit, but the rest is about the same. But when you look at the net cash flow difference, so on the Hawaii property, if we go back here, the net cash flow is $21.51 on a monthly basis. The net cash flow here is $44.81. So you're over double the net cash flow. And so you might say, well, yeah, but I've got this nicer property in Hawaii. But what you're not considering is this column right here, which is super important to look at if you're going to compare apples to apples. Because to buy that property that's twice as expensive, you're going to need about twice the cash to purchase it. Both similar types of properties, both turnkey, but that one's so much more expensive that you're putting so much more of your assets, your cash into that deal. And so your return on this one compared to that one, because it's bringing in twice as much cash because your expenses are lower, it's bringing in twice as much cash flow on a monthly basis, and you only paid half. Now your return on every dollar invested is 42% in this situation compared to 10% in the Hawaii deal. So it's 4 times as much. So if over twice as much monthly net cash flow and 4 times the cash on cash return doesn't win you over for the Canton property, I want to show you one more side by side to just really understand the difference between these two types of properties. So up top, if we look at the amount of capital needed to purchase the Hawaii property, this is between the down payment. The down payment is right here. It's $159,000 plus the furnishing costs, plus the repair costs, plus the closing costs. So that's how you come up with that $250,000. And then you compare that to the capital needed for the Canton property. Much smaller down payment, similar price point in terms of furnishing the property, similar in updates, much lower closing costs because it's a more affordable property. But you're going to need about half the capital to purchase the Canton property. So if you're comparing apples to apples, essentially, you could go out, if you had $250,000, you could buy one Hawaii property that like the one we just went through, or you could go out and buy 2 of the Canton properties. So now you're not bringing in twice as much net cash flow. Now you're bringing in 4 times as much net cash flow, or over 4 times as much net cash flow, because you're buying 2 of those properties, if that makes sense. So basically, if you compare side by side the net monthly cash flow, if you're going to invest the same amount into either 2 Canton properties or 1 Hawaii property, with 2 Canton properties, now your net monthly cash flow is $89.62 with the same amount of money invested up front. And so after 1 year, that's $107,000 of net cash flow that you put in your pocket. So there's a lot of people out there that can live on $107,000 annual income. So if you do this 2 times, then essentially for the rest of your life, you're financially free. You know, you've created $107,000. But if you start to look at that, what that looks like over time, and say you're working still, say you want to continue working and you want to just pocket this cash flow, that turns into over $1 million of net cash flow after all your expenses. This does not count any appreciation. This doesn't count tax savings. This doesn't count principal pay down. It doesn't count, you know, the depreciation that you're going to take. So that's over $1 million just of cash flow after 10 years. And you compare that then to the Hawaii property, because you can only buy one of them with the same amount of resources. And after 1 year, you're going to make about 25 grand, 129,250 after 10 years. So a lot of people would look at this Hawaii analysis and say, that's great. I'm cash flowing. I'm going to bring in $250,000 in 10 years. That is good. I mean, it's better than not cash flowing, right? You're buying a property that actually cash flows, which a lot of people will go out and buy properties that don't, and they'll just bank on the appreciation over time. But in both cases, you're going to get appreciation. Yes, Hawaii most likely will be higher appreciation. You know, you can't predict exactly what that's going to look like, but the Hawaii property, it's an $800,000 property. If over the next 10 years, it would come in anywhere close to the type of return that we're getting in Canton, it would have to over double in value in the next 10 years, and it still wouldn't touch it because we're still going to have appreciation on the Canton property. We still have created $1 million of cash flow, or a difference of about just over $800,000 in cash flow on these 2 Canton properties that we bought with the same down payment and resources that it took to purchase that 1 Hawaii property. So I know this video got pretty technical, so you may want to go back and reference some of the numbers again. And I'll be the first to admit that there's a lot of variables in both these scenarios. So it's not going to turn out exactly the way I predicted. You can't predict every single booking and exactly what the occupancy and exactly what the nightly rate's going to be, but you can get a pretty close ballpark based on the data from the other properties right in that area. And so even if we're anywhere close in the same ballpark on both of these analysis, you can see why the Canton property far outperforms the Hawaii properties when you're comparing apples to apples. And also, I mentioned the First Vacation Rental Investment Blueprint program, which is where I walk people through step by step the entire process of finding, buying, and setting up the highest cash flowing properties possible, just like the one that Anthony owns, the one in Canton that I just went through. So everything is laid out, all the tools, everything you possibly need. So if you're interested in working with me in a program like that, you can set up a call with me at the link that is in the description below. So just scroll down to the description, you can click on the link and you can set up a call with me. Thanks for joining me for this video. God bless, and I'll see you in the next video.